Good morning. In today's session, we're going to cover the final piece of financial assets. In the earlier part of discussions, we said that a financial asset can be measured either at cost or at fair value. When I say the fair value, it means that the company doesn't have a choice to show the financial assets at cost. By virtue of their intention to hold the asset, the classification is identified. For example, if there are financial assets which company holds for trading purposes, they must be necessarily classified at fair value. However, even if the company does not hold financial assets for trading purposes and the company would like to measure these at fair value, these changes in the value of the investment or the financial asset may be done through other comprehensive income. This choice has to be made by the entity at the time of initial recognition itself, and this is an irrevocable decision. We'll take a few examples around this to support whether an asset or a financial asset should be shown at cost or at fair value, and if it is taken at fair value, whether the changes should be routed through the P&L or it should be routed through the other comprehensive income. For example, K Limited has invested in 3 years redeemable preference shares of T Limited. K Limited has an intention to hold these shares until maturity and recover the cash flows through dividend and principal repayment. At this point in time, the business model of the company is to recover the contractual cash flows by way of recovery of dividend and principal repayment. Hence, these should be measured at cost. In the second scenario, say that K Limited is invested in the bonds of T Limited. The intention is to hold these bonds for a longer term. However, K Limited has decided to show this investment at P&L. Now, at a discretion of K Limited, these investments or the financial assets may be shown at fair value, and any changes of those would be routed through profit and loss account. In the third scenario, we say that K Limited has receivables of $5 million from T Limited. The business model of K Limited is to sell off the receivables and recover money the moment sales are made. A pure factoring arrangement, we can say. In this point in time, the business model of the K Limited is not to recover contractual cash flows through recovery of principal and interest repayment. Hence, these receivables must be shown at fair value. K Limited, in the for example, it has invested in debentures of T Limited. It has an intention further to hold these debentures until maturity. However, if K Limited sees a gain, it may think of selling off these debentures to realize a gain. Although initially the intention of the company is to hold these debentures until maturity, however, the intention actually is to realize the gain. Hence, it can be presumed that K Limited is holding these shares for trading, holding these debentures for trading purposes. Accordingly, these must be measured at fair value, and that too through profit and loss. There are further annotations which say that if there is a perpetual debt, that is, which has no maturity, it is always taken at amortized cost. The recovery of both principal and interest necessarily happens through the interest recovery itself. And finally, if there is a debt instrument which is a convertible debt, it must be taken at fair value rather than amortized cost, because there would not be, or there is no expected to be, any recovery happening through recovery of contractual cash flows in form of principal and interest. The moment this debenture converts into shares, there is no recovery that is expected by the holder of these debentures. Just to summarize, the financial asset can be categorized into two categories or classified into two categories, that is at amortized cost or at fair value. For amortized cost, the company's business model should be to recover contractual cash flows, and that too for the purposes of recovery of principal and interest repayments on specified dates. For the purposes of fair valuation, it can be taken at either through P&L or it can be taken through other comprehensive income. A financial asset should be taken at fair value through profit and loss only if the company's business model is to trade into these kind of financial assets. Thank you very much.